Here's something most freelancers don't find out until their first tax filing. The IRS lets you deduct 100% of your health insurance premiums from your taxable income, not as a business expense buried in Schedule C, directly off your adjusted gross income. That distinction matters because it lowers the income number before almost everything else gets calculated. According to the Kaiser Family Foundation, the average individual marketplace premium in 2025 was $477 per month before subsidies. At that rate, you're looking at over $5,700 a year flowing through your taxes unclaimed if you're not using this deduction. And in 2026, the ACA marketplace has updated plan structures and subsidy thresholds that change how you should choose your plan. In the next 12 minutes, you'll know exactly how to claim this deduction, which plan type to pair it with, and how to stack it with an HSA to squeeze every dollar out of the system. How the self-employed health insurance deduction actually works. Let's get precise about what this deduction is, because the mechanics matter. The self-employed health insurance deduction lives on Schedule 1 of your Form 1040. It is an above-the-line deduction. That means it reduces your adjusted gross income, not just your taxable income after standard deduction. The difference is significant. A lower AGI can reduce your exposure to the net investment income tax, keep you eligible for ACA subsidies, and affect your QBI deduction under Section 109.19a. This one deduction has cascading effects. According to the IRS, you qualify if you were self-employed and had a net profit in a given month, and no employer-sponsored plan was available to you or your spouse during that month. That available language is the one that trips people up. If your spouse had access to employer coverage, even if they didn't enroll, you lose the deduction for those months. Your situation may vary depending on your spouse's employer benefits, your filing status, and whether you had any W-2 income yourself during the year. You can deduct premiums paid for yourself, your spouse, your dependents, and children under age 27, even if those children aren't your dependents for tax purposes. That's a meaningful expansion most people don't know exists. The deduction covers medical, dental, and vision premiums. It does not cover premiums paid through a health reimbursement arrangement funded by someone else. And the deduction cannot exceed your net self-employment income for the year. If your freelance income was lower than your premiums, there's a cap, but in that case you likely qualify for marketplace subsidies that reduce the premium anyway. My take is simple. If you're paying for your own health insurance and you're not claiming this deduction, you are writing a check to the IRS that you legally don't owe. Choosing the right 2026 ACA Marketplace plan. The deduction only works if you have a qualifying plan. So let's talk about how to pick the right one in 2026. CMS confirmed that ACA Marketplace enrollment hit a record 24.2 million people in 2025. That means more plan options in most states, which is good, but also more noise to cut through. Here's the framework. Your plan choice in 2026 should be driven by two things: your expected annual health care use and your income relative to the federal poverty level. For 2026, the FPL for a single individual is set at $15,650. If your net self-employment income lands between 100% and 400% of that, roughly $15,650 to $62,600, you qualify for advanced premium tax credits that reduce what you pay monthly. Because the self-employed health insurance deduction lowers your AGI, it can actually pull your income into a more favorable subsidy bracket. You are not double dipping. The IRS allows this. It is legal, it is intentional, and it is exactly the kind of leverage your former employer got automatically. Now, plan type. There are 4 metal tiers: bronze, silver, gold, platinum. The right move for most healthy freelancers with moderate income is a high deductible health plan, which typically appears at the bronze level. Here's why. An HDHP makes you eligible for a health savings account. That's the stacking strategy we'll get to in a moment, and it's where the math gets genuinely powerful. If If you have a chronic condition, take regular prescriptions, or have young kids with frequent doctor visits, the math shifts. A gold plan with lower out-of-pocket costs may come out ahead even at a higher monthly premium. Run the numbers using your actual expected utilization, not just the monthly cost. Silver plans have one specific advantage. If your income is between 100% and 250% of the FPL, you may qualify for cost-sharing reductions, which are only available on silver plans. CSRs lower your deductibles and copays beyond what the premium credit covers. If that income range applies to you, silver beats bronze regardless of the HSA. The HSA stacking strategy. If you choose an HDHP, and for most freelancers the right move is to strongly consider it, you unlock a health savings account. The HSA is one of the most underused accounts in personal finance. For 2026, the IRS set the HSA contribution limit at $4,300 for self-only coverage and $8,550 for family coverage. If you're 55 or older, you can add an extra $1,000 catch-up contribution on top of that. Here's why this matters so much. HSA contributions are tax deductible, growth inside the account is tax-free, withdrawals for qualified medical expenses are tax-free, that is triple tax advantage, the only account structure like it in the entire U.S. tax code. Now stack that on top of the self-employed health insurance deduction. You're already pulling your premiums off your AGI. Then you contribute to an HSA and pull that off your AGI too. A freelancer in the 22% federal bracket who maxes out a self-only HSA at $4,300 and deducts $5,700 in premiums is sheltering roughly $10,000 from federal income tax. At 22%, that's $2,200 back in their pocket. That's not a rounding error. One more thing about HSAs. After age 65, you can withdraw for any reason without penalty. You pay ordinary income tax on non-medical withdrawals just like a traditional IRA, which means a maxed out HSA is functioning as a backup retirement account. I'd be contributing to it every year regardless of whether I expected big medical bills. Your tax benefit will vary by bracket. The higher your income, the more each dollar of deduction saves. But the stacking strategy is the right default for most freelancers on an HDHP. Income thresholds, subsidy interaction, and the cliff to avoid. Here's where the rules get interesting, and where getting this wrong costs you real money. The ACA subsidy is calculated against your modified adjusted gross income, which is based on your AGI plus a few add-backs. Your self-employed health insurance deduction reduces your MAGI for subsidy purposes. That is a direct dollar-for-dollar improvement in your subsidy eligibility. The number to watch is 400% of the FPL. For a single filer in 2026, that's approximately $62,600. If your income lands above that threshold, your subsidy phases out. For a long time, even $1 over that line meant losing your entire subsidy. That was the subsidy cliff. Congress eliminated the hard cliff through 2025. As of the date of this video, legislators have debated extending that relief into 2026 and beyond, but no permanent fix has been signed into law. Watch this space. If the cliff returns, projecting your income and timing deductions becomes critical. Here's the strategic play if you're near the threshold. Maximize your self-employed health insurance deduction. Contribute to your HSA. Make retirement contributions to a solo 401k or SEP IRA. Every one of these reduces your MAGI and keeps you in favorable subsidy territory. None of this is aggressive. It is exactly what the tax code was designed to reward. I help freelancers figure out the money side of going solo, and this is one of the most concrete high-leverage places to start. The IRS did not design these rules to be hidden. They just didn't send you a benefits coordinator. One individual variation note here. If you have highly variable income, common for freelancers with project-based work, your actual MAGI may be hard to predict. The marketplace lets you update your estimated income during the year. Do that if your income changes significantly. Underpaying the premium tax credit means a repayment at tax time. How to claim it. the mechanics, and common mistakes. Let's walk through the actual filing mechanics so you don't fumble this at the finish line. You claim the self-employed health insurance deduction on Schedule 1, line 17 of Form 1040. You do not put it on Schedule C. Many tax software programs prompt you for this correctly, but if you're filing manually or using a preparer, confirm it's going on Schedule 1, not buried in business expenses. The amount you deduct is the premium you actually paid, not the full plan premium if you received advance premium tax credits, only what came out of your pocket after credits. The IRS is clear on this. You cannot deduct the portion of your premium that was covered by your premium tax credit. According to the IRS Statistics of Income data, the average self-employed health insurance deduction claimed in recent years was approximately $5,400, but averages hide a lot. Family coverage pushes that number much higher. Dental and vision are separate lines in most plans. Add those up and include them. Keep documentation. Keep proof of premium payments. Keep your 1095-A form from the marketplace. That form shows what you paid, what the full premium was, and what the government covered. You need it to reconcile your premium tax credit on Form 8962. The most common mistake I see, freelancers who got a subsidy and then assume they can deduct the full premium, including the subsidized portion. You cannot. Deduct only what you actually paid. The software usually handles this if you enter your 1095-A correctly, but verify it. Second most common mistake, forgetting dental and vision. Those premiums count. Track them separately and add them to your total. Putting it all together. Here's the playbook for 2026. Pick an ACA marketplace plan during open enrollment, or now if you're in a special enrollment period. If you're healthy and your income is above 250% of the FPL, a high deductible health plan is the right default. It keeps your premium low and unlocks the HSA. If your income is between 100% and 250% of the FPL, check whether cost-sharing reductions on a silver plan outweigh the HSA benefit for your situation. Open an HSA immediately if you're on an HDHP. Contribute up to the IRS limit. For 2026, that is $4,300 for self-only, $8,550 for family. At tax time, claim the self-employed health insurance deduction on Schedule 1. Add premiums for yourself, your spouse, your dependents, and eligible children under 27. Include dental and vision. Deduct only what you paid out of pocket after any marketplace subsidies. Track your MAGI relative to 200%, 250%, and 400% of the federal poverty level. Those are the thresholds that change your subsidy structure. If you're close to any of them, additional deductions and retirement contributions especially can shift you into better territory. That's it. That is the framework your HR department would have handed you on day one at any corporate job, except your corporate job would have picked up half the premium. Going solo means you fund it yourself, but you also get to deduct the entire thing. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this gave you a clearer picture of where your money is going and how to keep more of it, hit subscribe. New videos go up every week built specifically around the financial mechanics of self-employment. Drop a comment with the freelance finance question you want me to tackle next. I read every one and I build the content queue from what you're actually dealing with. And speaking of keeping more money in your pocket, next week's video is one you don't want to miss. Most freelancers using a solo 401k are making a contribution calculation error that quietly costs them thousands every year. I'll show you exactly where the math breaks down and how to fix it. This video may contain affiliate links. I only recommend tools I use personally.